So thank you very much for having me, and thanks everyone for coming to the talk. So today I'll be telling you about monetary transmission through Q. So this is a joint project with Ricardo Lagos at NYU, who is also here present in the audience. Oops, sorry. Okay, so in this paper, we address the broad topic of how monetary policy affects investment. So more specifically, we're thinking about a certain mechanism that people sometimes have in mind when talking about channels of monetary transmission. And the general idea behind the channel is that monetary policy affects equity prices. And this naturally implies changes in Tobin's Q, meaning the market value of firms relative to the replacement cost of capital. Now, if, for example, Q is high, firms could issue equity at a higher price, and this could lead to a boost in investment spending. Yet to our knowledge, this explicit channel working through equity prices has not received much focused attention in previous research. And we believe this is likely because this channel is difficult to identify and isolate in a systematic manner. So for example, equity prices and Q are themselves endogenous objects. So how do you even think about an isolated effect of monetary policy on stock prices? Moreover, the channel relies on a causal effect going from stock prices to investment, which can also be hard to identify. And in this project, we make an attempt at documenting this channel. So how do we do that? Well, first, we construct a model of monetary trade in financial markets. A frictional trade in these markets implies that equity prices can be decomposed into two components. First, there is what we call the fundamental component of equity prices, and under this you should literally think of as the expected present discounted value of dividends. And this we think of as being more driven by firms' day-to-day operations and the returns to physical capital. And secondly, there's also a liquidity component in equity prices, which arises from a resale option value in these frictional equity markets. And this component we more think of being driven as, or so driven by, trading activity and liquidity in these frictional financial markets. And we refer to this part of the model as the financial markets block. Now, the second key component of the model is what we refer to as the investment block. And this consists of heterogeneous entrepreneurs, or who we'll also refer to as firms interchangeably, who make capital investment decisions while facing financial frictions, but also being able to raise funds by issuing equity claims on their capital stock. The key implications from this block of the model is that because these entrepreneurs can finance themselves by issuing equity, fluctuations in equity prices could have an effect on investment, but actually it will only affect the investment of those firms who actually rely on equity financing at the margin. So how does monetary policy matter in all of this? Well, because monetary policy affects the opportunity cost of holding the liquid assets used for settlement in these frictional equity markets, monetary policy can affect trading activity in equity markets and thus has an effect on the resale option value of equity. So that is, monetary policy can affect equity prices through this liquidity component, and thus through equity prices potentially have an effect on investment in this world as well. Importantly, the strength of this effect of monetary policy on an individual firm's stock prices depends on the trading activity and the trading volume of its equity in financial markets. And we will use this idea to construct an empirical instrument for equity prices when we go to the data. So what do we do with the data? So when we look at our empirical work, we ask, or we address, two big questions. So first of all, how do monetary policy shocks affect equity prices? So of course, this is a big question that has received a lot of attention already in previous work. For example, famously by Bernanke and Kuttner, who find that in response to a surprise policy rate hike, there's a substantial fall in broad stock market indices in the US. On top of that, previous work by Ricardo and James Zhang has uncovered that within this overall drop in stock prices, there's considerable heterogeneity across different stocks' responses. And this heterogeneity, a lot of this heterogeneity can be explained by actually the stock turnover in these stock markets. Okay, so what we will do is actually just simply revisit these findings in our quarterly data, because many of these findings, of course, were found using high-frequency daily data. We'll just revisit these findings in our database first using quarterly data. Now, more importantly, we take the next step, and then we want to ask whether these equity price responses can in turn have an effect on firms' behavior, most importantly, their investment and their equity issuances. So to do that, we first simply estimate whether firms' turnover, so turnover heterogeneity in the cross-section, predicts firms' investment and equity issuance sensitivity to monetary policy shocks. Given our findings and given the predictions and the insights from our theoretical model, we will then take the final step and we will actually construct an instrument for cross-sectional variation in firms' Tobin's Q using identified monetary policy shocks and the firm's stock turnover to construct an instrument, cross-sectional instrument for Q, and try to get at a causal estimate of stock prices on firms' investment and capital structure. So what do we find? Well, in line with earlier work, we find that in response to monetary policy shocks, unconditionally among all firms, higher turnover predicts stronger stock price responses, exactly as found earlier, for example, in Ricardo's earlier work. However, higher turnover only predicts stronger equity issuance responses and investment rate responses among firms who have relatively low liquid asset holdings on their balance sheet. And we will think of these firms as, so to speak, the equity dependent, the low liquidity firms who actually are more likely to have to rely on equity financing at the margin. Given these findings, when we take the final step to the ID regression and instrument Q in the cross-section of firms, we will then find that higher instrumented Q will lead to higher equity issuances and higher investment, again, among these firms with relatively low liquid asset holdings. So these numbers here exactly have to be classified because we trace out the whole dynamic response of firms' investment and equity issuances in response to this instrumented change in Q, but these are simply just to give you some taste of the peak effects. And finally, we give a very rough back of the envelope estimation or calculation of how much of the aggregate effects of monetary policy on aggregate investment could this transmission channel through stock prices explain in the US. And we find that about 1/3 of the conventional estimates of monetary shocks on aggregate investment could actually be explained by this channel going through stock prices of firms. Okay, so of course, this work, our work is touching upon many strands of the literature with a lot of work and a lot of influential work in them. So first of all, of course, we're touching on the literature on different types of monetary transmission mechanisms. So here, of course, the literature is too big to give a broad overview, but here I'm just bringing out two influential references that give a very broad picture of different transmission channels. And for example, interestingly, Mishkin gives a very loose taxonomy of all kinds of transmission channels. And among others, he brings out this Tobin's Q channel that he thinks of as separate from more conventional channels like the New Keynesian channel that arises from real rates changing in response to monetary policy shocks. Now, of course, our work also touches upon the body of work that focuses on the Q theory of investment, and again, many influential papers therein. But our current reading of this literature is that this literature doesn't concern itself too much with which way causalities run. Rather, this literature is more focused on testing the Q theory of investment in the sense of testing whether the investment rates that we observe in the data are well correlated with measures of the shadow price of a unit of installed capital, or as it is referred to in this literature, the marginal Q. Now, of course, the marginal Q is not observable in the data, and so what papers in this literature often do is, well, then they use stock prices, meaning Tobin's Q, to proxy for marginal Q. Okay. However, so for example, famously Hayashi in his paper shows conditions under which marginal Q and Tobin's Q are actually equal. But even in his model, stock prices are just a sideshow, meaning that stock prices reflect the average value of a unit of installed capital, but there's no causal effect of stock price fluctuations on investment in Hayashi's work. And this brings us to the third bullet point here. And so there's actually quite a long literature of papers that explicitly think about the idea that whether anything that goes on in the stock market does or should have an effect on firms' investment. So these ideas started already with Keynes. He talks about these kinds of ideas in his book. Then these ideas were resurrected by Tobin, and thereafter there have been many papers thinking about these kinds of ideas. And again, these types of papers explicitly concern themselves with the idea that if there are fluctuations in stock prices, does that lead to a response in firms' investment through an equity financing channel? And some of these papers might look at these ideas from very different perspectives or framing the question very differently. Like some papers by Gilchrist, for example, ask, should stock market bubbles have an effect on firms' investment, or do they have an effect? Whereas some papers here in the corporate finance literature more frame this question of, do stock mispricing effects, or does stock mispricing have an effect on firms' investment? So what we contribute to this type of a literature is we provide a very simple general equilibrium model to try and think about these kinds of effects. And then we propose a new instrument for fluctuations in Tobin's Q that is not caused by marginal Q to try and think about these effects as well. And finally, our paper also actually touches upon the corporate finance literature that looks at whether macro conditions and stock price fluctuations can have an effect on firms' capital structure. So in the rest of today's talk, so what I'll do first is I will set up our model and I'll explain to you how our model works and behaves and its most important features. Then in today's presentation, I will take the model to two extremes. First, we will consider a very simplistic version of the model that is easy to characterize analytically, and that will help us formalize how to think about estimation and identification in the data. Then I will present a reduced form empirical work of again, these insights coming from the model. And then in the end, we will go to the other extreme with the model. We will take a full quantitative calibrated structural approach with the model, and we will verify whether our identified reduced form impulse responses that we find in the data actually are in line with a structural calibrated model's impulse responses of the same channel. Okay, so if there are no questions until now, I will immediately jump into the model then.
Could I interrupt you 1 second?
Yes. Yep.
I am Ernesto Pastel from the bank. Hi. I have two quick reactions that I would like to know whether they're related to the paper or not. The first one is that there is a relatively new literature that argues that monetary policy shocks are not clean measures of, let's say, non-systematic changes of monetary policy because it could be confounded with information effects. Yeah. So I wonder whether these two components are informative to the model in different ways, or just to care about the net effect of both, or what? The second one has to do with also relatively newer literature that argues that monetary policy shocks tend to have stronger effect on investment of firms that are not that financially constrained. And I understand that the model is going to be different, but since you're going to be talking about Tobin Q, and it's supposed that investment in firms are not that related to Tobin Q, one of the ingredients that people have been blamed are financial frictions. So I wonder how the two things we may relate it, the evidence that you're going to show us at that type of evidence. Particularly, I'm thinking about Ottonello Winberry.
Yeah. So So first of all, about Ottonello and Winberry. So definitely we are, of course, sympathetic to that literature because my own job market paper is also on exactly that topic. And so the way we're looking at this in the scope of that literature is that this is an extra channel, an extra source of heterogeneity that could lead to firms responding to monetary policy shocks differently. And definitely we are concerned about those findings of whether high leverage trade makes firms more responsive or less responsive, whichever way it goes. We will want to control for those types of effects. And then what we want to look at on top of that, once we control for leverage, what do these kinds of effects say? Now, let me just quickly add on top of that financial frictions will play an important role in our model as well. So basically, the way we look at our model in the scope of financial frictions is that these firms in our model, they will face financial frictions, and while facing financial frictions, they can also finance themselves with equity, okay? And then the way we're thinking about this whole transmission channel is that monetary policy has an effect on equity prices, and then these firms who have to rely on going to the equity market, issuing new external equity, will expose themselves to equity price fluctuations, and then they will be subject to this extra source of fluctuations. But we are completely sympathetic to the literature discussing any other types of sources of, let's say, heterogeneity coming from, for example, the rates at which firms can borrow. And so we're just thinking of our channel something on top of that. And your first question was about us. So it was about the information channel. So again, the way we're thinking about it right now is that we would still think about these monetary policy shocks that we have in mind in the model and the data as pure, pure classical monetary policy shocks that do not have the information content in them. So in our baseline, so if I'm more specific, in our baseline work, we will just simply consider the rough, raw, high frequency federal funds futures rate changes that might contain the information channel, or sorry, the information revelation of the Fed in them. But then in robustness tests, we also use the Yarochinsky and Karady channel, or sorry, the decomposition, to show that our main findings also survive if you take out the information effect. Now, but as I understand, you had this extra question of whether, if we look at our monetary responses, or sorry, these responses to these different types of components, whether that would help us identify something. That's a good question. I would have to think of that. So definitely one thing I can say that in light of our really basic model that I show you today, I would think that the information channel, the way as Yarochinsky and Karady define it, it would push, like it would have the exact same effects, but just in the other direction. So basically, when the Fed raises rates, in our model, that raise in the rates purely is an increase in nominal rates, and then nominal rates matter for stock prices in the model. Now you're telling me, suppose we instead shock the investors' expectations about the future, and we give them a good shock that affects stock prices, and will have the same transmission channel, but only just in a positive direction. Okay. All right. Okay, but again, as a short answer, let us think about just pure monetary classical nominal rate shocks. All right. So let me get to the model. So we're considering a model, a discrete time model, with an infinite horizon. So the model is in discrete time, and each period t of the model is split into two subperiods. There are three different types of agents in the model. First, there are infinitely lived investors. There's a unit mass of them, and there's also a unit mass of infinitely lived brokers. Okay. There's also a unit mass of agents who we call entrepreneurs, who live for a stochastic number of periods. Okay, so epsilon, this ET here is simply the set of identities of entrepreneurs alive at the beginning of period t. So these entrepreneurs, between the first and second subperiod of every period t, a fraction 1 minus pi of them dies and immediately gets replaced by newly born entrepreneurs. So between these two subperiods, the probability of survival for an entrepreneur is pi. So that is, there are these death shocks, and this is why there's churning in terms of entrepreneurs not being fully infinitely lived. There are three types of commodities in this economy. There are two consumption goods. These consumption goods are both perishable, and they only exist in the corresponding subperiod. So consumption good 1 in subperiod 1, and vice versa for consumption good 2. There's also a capital good, which is storable, but it depreciates at rate delta between any period t. So where do these goods come from in terms of endowments and production? So first of all, in terms of the first subperiod, there isn't too much interesting going on in terms of endowments and production. So all the entrepreneurs alive at the beginning of the first subperiod of period t can use the capital that they themselves have in place to produce z times k units of good 1 at the end of subperiod 1. This z here is simply a parameter, a productivity parameter that is constant across time and across entrepreneurs. Also note that because this good 1 comes out of the production from capital, I might also refer to this good 1 as the dividend good in the rest of today's talk. Now, in the second subperiod, first of all, investors and brokers have access to what is called, or they're endowed with what is called labor or effort that they can use to produce good 2, 1 for 1, subject to a simple labor disutility cost. Now, as for the investors, first of all, these newborn investors who are born at the beginning of the second subperiod, replacing the dying, sorry, not the investors, the entrepreneurs. These entrepreneurs who are born at the beginning of the second subperiod, they are born with an endowment K0 of capital and an endowment W0 of units of good 2. So we think of these W0 as these newly born entrepreneurs' initial financial liquid wealth that they start off with. And we will describe the distribution or the heterogeneity in these wealth distribution based on the CDF omega, but more specifically, the ratio of these financial assets or financial wealth relative to an entrepreneur's starting capital follows the CDF omega. And so this is also actually foreshadowing a feature of the entrepreneur's problem, that actually everything will be homogeneous of degree 1 in this world for the entrepreneurs. So what really matters is the ratio of liquid wealth to capital that they are born with. And so finally, what can the entrepreneurs alive in the second subperiod 2 do? Well, they can use good 2, and they can use their capital that they have already in place from before to invest and create new units of capital. So XT here simply denotes new investment, and we will have the simplest textbook Q theory convex capital adjustment cost in place, where the C is simply convex in investment X, and it's homogeneous at degree 1 in X and K. Okay, so again, think of the most basic textbook Q theory capital adjustment costs. Later on, you'll see there will be quadratic. Okay, now, as for the preferences of these agents, so first of all, the preferences of the brokers. So here you see their preferences. They have a discount factor beta, and they get utility from consuming good 2 in the second subperiod of every period T. So this is what this calligraphic YT here refers to. And this HT here is this utility from supplying labor to produce good 2 in the second subperiod of period T. Now, in the second row, we have the preferences for the investors. So investors have the same discount factor beta, and they also get utility from consuming good 2, and this utility from supplying labor to produce good 2 in the second subperiod. Now, these investors will have an extra term here, the CT term here, and this is their consumption of good 1 at the end of the first subperiod of period T. And this epsilon T here is an investor's idiosyncratic valuation shock that governs the value they get from consuming good 1, the dividend good. This epsilon here is idiosyncratic across time and across entrepreneurs, and it follows a CDFG with a mean value of epsilon bar. And finally, in the last row, we have the preferences for the entrepreneurs. Again, and more specifically, these are the entrepreneurs born in the second subperiod of period T. So again, they have the same discount factor. Here is their survival probability. And so what these entrepreneurs, again, get utility from is they get utility from consuming good 2 in the second subperiod of period J now. So because, yeah, so we're indexing here with J. And these entrepreneurs also get utility from consuming the dividend good that their capital returns them in period J+1 in the first subperiod. Epsilon E here is the entrepreneur's valuation from consuming good 1, and epsilon E will actually take as a parameter, and it will be fixed across time and across entrepreneurs. So notice a few things about a few important distinctions and differences between the preferences of these different types of agents. First, notice that the brokers will not get utility from consuming good 1 or the dividend good, and as you'll see later, this is just an assumption made based on the conventions in the search-based OTC literature that brokers have no motive to hold on to financial assets for consumption motives, and they will just behave as intermediaries in this economy. Secondly, notice that because these epsilon T shocks are idiosyncratic across investors, these will generate gains from trade between investors at a certain point in time in this model, and that you'll see in the following slides to come as well. And then finally, notice that entrepreneurs cannot use labor to produce good 2 as freely as they wish. And we make this assumption to allow us to model financially constrained entrepreneurs who cannot just work their way out of financial constraints. Okay, so let me go on now to the assets in the model. Okay, so what kind of assets can the agents trade? So most importantly, in the second subperiod of every period T, the entrepreneurs alive at that given point in time can issue identical, durable, and perfectly divisible equity claims on the returns of their capital stock. Okay, so more specifically, each individual equity share represents the ownership of the future stream of good 1 that a unit of capital spits out all the way going down the line into the future. All right, so this equity is really a simplistic, claim on the stream of dividends paid by a unit of capital. Now, if an entrepreneur dies, all the equity units that the entrepreneur had issued in the previous periods disappear, and any capital and financial assets that the entrepreneur holds will be redistributed among the newly born entrepreneurs. And the newborn entrepreneurs start with 0 outstanding equity. There are 2 other types of assets, financial assets in this economy. There are really simple 1-period real discount bonds issued by the government. And so here, this 1 unit of this bond issued in the second subperiod of period T simply constitutes a claim, a risk-free claim on 1 unit of good 2 in the second subperiod in period T plus 1. So really, really basic 1 period discount points here. And then finally, in the model, there's also fiat money, which is intrinsically useless, meaning that money doesn't enter anyone's utility functions or production functions. And it does not constitute a formal claim to any goods, okay? But it still can be traded and valued in a monetary equilibrium in this model. So here, we're showing you the monetary policy process as something very simple, where just the stock of money grows at a constant rate chosen by the monetary authority. Later on, we will actually also consider completely unexpected shocks to this money growth process that will generate fluctuations in nominal interest rates in this economy. But for now, just think that money grows at a very simple constant rate in this economy. And finally, we make a simplifying assumption again for presentation that brokers do not hold financial assets in this economy. And again, this is just for ease of presentation, so we don't need to start solving the broker's portfolio problems. But actually, Ricardo's earlier work has also relaxed this condition in these kinds of frameworks, and it shows that the main insights, what we need from this framework, also go through if you were to allow brokers also to hold on to financial assets across periods. All right, and then finally, the last slide on the setup of the model. This slide depicts you the market structure and the timeline of what's going on then in one period across the 2 subperiods. So let me first start with a more basic second subperiod. So in the second subperiod, all the agents, the investors, entrepreneurs, and brokers, they meet in a Walrasian market where they can trade money, equity, bonds, and good too, okay, in this Walrasian market. Now, as for the first subperiod, in the first subperiod, only money and equity can be traded. Okay, first of all, there will be a Walrasian market where all the brokers meet each other and they can freely trade equity against money between each other in this Walrasian market at a nominal price of equity PT. Now, as for investors, investors could potentially have the opportunity to match with brokers and trade with brokers in a random bilateral OTC market, an over-the-counter market. So each individual investor has a probability alpha of matching with a broker and then getting access essentially through the broker to this interbroker market, okay? So once an investor and a broker match, what they do is they negotiate over the quantities and over the quantities of equity and money that the broker trades on behalf of the investor in this interbroker market, and the broker will also get a fee for his intermediation services. The terms of trade in this bilateral match will be determined by Nash bargaining, where theta is the bargaining power of the investor. Also importantly, because of anonymity and lack of enforcement and commitment, you cannot buy equity in this economy on credit, or you cannot borrow to buy equity and then pay back later. And so because of this, there's the need for a medium of exchange to buy equity, and money will actually exactly be this medium of exchange in this model. Also, importantly, about some of the timing assumptions within this first subperiod, we again make some conventional timing assumptions that this trade in this OTC market happens before capital and equity pay out these dividend goods that the owners have claims to. However, the trade in the interbroker market happens after the investors realize their individual epsilon shocks that are revealed completely at the beginning of the period. Also, as is conventional in this OTC market or OTC-based search literature, in order for you to enjoy the consumption flow of the dividends that your equity gives you, you have to be an owner of the equity, or you're the owner of the equity at the end of the first subperiod. Okay, so here you see where really the gains from trade come from. That at the beginning of the period, the individual investors' preference shocks will be revealed. Some guys will have high utility, some guys will have low utility from consuming the dividends, and then there will be gains from trade to be had in this OTC market, transferring equity from low valuation guys to high valuation guys. All right, so now that's it for the model setup. So let me go to explaining how the structure, how the equilibrium of the model and the solution of the model looks like. So instead of going through all the Euler or the Bellman equations of these investors here in the model, for which we really don't have time for, let me directly jump to describing how trade in the OTC markets will look like, and also what the Euler equation that determines equity prices looks like, and how actually monetary policy has an effect on anything in this economy. So first of all, what does trade in the OTC markets look like? So because of the linearity of preferences of the investors, the mass of investors who who match with a broker and get access to buying or selling equity in this interbroker market through the broker, this mass of investors will be split into two. Okay, so the high valuation guys, the high epsilon guys, will want to buy equity and spend all the money that they have with them to do so, and the low valuation guys will want to get rid of equity, sell it in exchange for money. And a key equilibrium object here of interest is the marginal investor with a valuation epsilon star, who is exactly indifferent between buying or selling equity in these OTC markets. Now, these outcomes in the OTC market of, say, period t plus 1, then imply an Euler equation for equity in the second subperiod of period t. Okay, and so this here is the equity Euler equation. Here on the left-hand side, what you have is simply the marginal utility cost of an investor acquiring equity. So this PS sub t is simply the real price of equity in period t in the second subperiod. So again, this is just the equity price. On the right-hand side, here you have the discounted expected utility from consuming dividends that these investors get, plus the continuation value of equity, plus you as an investor might be lucky to match with a broker in the OTC round in the upcoming period, and you might be able to realize some gains from trade in the OTC market. So really, this term here, why it appears in the equity Euler equation, is the marginal effect of carrying forward a unit of equity on your expected gains from trade from the OTC market. So where do these expected gains from trade, denoted here as this calligraphic RT plus 1, come from? Well, with probability alpha, you match with a broker, and you get the fraction theta of the bilateral gains from trade in the OTC market as governed by your bargaining power. Okay. Now, when do you get gains from trade in equity in the OTC market? Well, it's useful for you, equity increases your gains from trade only if you are on the selling side in the equity market, meaning that you have realized a lower draw of an individual investor's valuation than the marginal investor's valuation. Okay. On top of that, actually, because all the investors agree on the continuation value of equity in this model, you can actually show that the gains from trade for an individual epsilon valuation investor in this OTC market can actually be written as the difference between their valuation and the marginal investor's valuation in the OTC market. Okay, and so now you'll see that actually this term here, this gains from trade term, is exactly the resale option value of equity in OTC markets that I've been talking about. And notice that this resale option value and the marginal investor's valuation have a clear positive relation between each other. Note that the resale option value is higher if you're more likely to be on the selling side in the OTC market, okay? Plus, your resale option value is higher if you're selling to an OTC market where the marginal investor's valuation is higher, meaning actually that the stock prices in the OTC markets are higher, okay? So whenever the marginal investor's valuation in the stock market is higher, you as a seller are happier to be selling the equity to that type of a market, okay? And that's why this R here shows up in the equity prices and will start affecting equity prices in this model. Now, on the other hand, the marginal investor's valuation will also have to satisfy an Euler equation for holding money, where now the marginal gains from holding money in the OTC market arise whenever you want to be a buyer in the OTC market and you actually want to buy equity, okay? And that's when you use money in the OTC market. Now, notice that, or whenever nominal rates are high, meaning that the opportunity cost of holding money is high, okay? Again, nominal rates are literally the opportunity cost of holding money. So whenever those are high, these investors in the economy will want to hold lower real balances, and that will push down their purchasing power if they want to buy equity in the OTC market. So higher nominal rates will actually push down equity valuations in the OTC market and also push down the marginal investor's valuation. And so this altogether now shows you how the financial markets block of the model tells you how monetary policy affects equity prices in the economy. Okay, again, higher nominal rates make it more costly to hold money. There are fewer real balances are held by investors, pushing down their ability to buy equity in the OTC market. And this pushes down the marginal investor's valuation. And then in turn, that pushes down the resale option value of equity, immediately translating into a lower price of equity today. Okay. Any questions about this until now?
Yes, Ernesto, again,
Yep.
very quick. So
Yep.
this creates a relation between more stringent monetary policy and implies lower prices of equity.
Yes.
And also it should be lower volume, no? Lower trade
Absolutely.
volume.
Yes, absolutely. Absolutely. That is an important part that is going on here. Exactly.
And
exactly
therefore you
monetary
have
shocks.
two testable predictions coming out of this slide.
Yeah. Yes.
Okay,
so
good.
Yes. So actually, one important thing to let me point out is that actually this structure, this how monetary shocks affect equity prices, actually this we're building upon and actually taking quite closely from Ricardo's earlier work with Sheng-Xing Zhang, this paper I referred to. And they actually very diligently with daily data, daily stock return data, look at all these predictions. They look at the stock response predictions, they look at turnover response predictions, and they, most importantly, as I'll get to it, they look at these heterogeneous price response predictions as predicted by the model. And I'll get back to that. But again, all of those things have actually already been tested by Ricardo in earlier work. But thanks. Yeah, you're absolutely right.
Okay, thanks.
Okay. Now, to give you an illustration of the investment block here, I'm just presenting you the full dynamic problem of an individual entrepreneur in this economy. So J is the value function of the entrepreneur. And in general, the state variables of the entrepreneur are first AB, which denotes the liquid funds held by, or liquid, sorry, to be precise, liquid financial assets held by the entrepreneurs in the form of these bonds in this economy. And think of this as the model counterpart to a composite of cash, short-term deposits, time deposits, treasuries, and all kinds of financial assets that firms in reality might hold to manage their liquidity. Okay, so think of that as the liquid assets held by firms in reality. We call these assets liquid assets to contrast them to the productive capital K that these entrepreneurs also hold. And then finally, S here denotes the equity that the entrepreneur has already sold on his capital stock in previous periods. So S here is the outstanding external equity that the entrepreneur has sold previously. So here you see the entrepreneur's problem. So the entrepreneur chooses how much to consume of good 2 in the second subperiod, how many liquid funds to carry forward, how much to invest in capital X, and how much new equity to issue E. Here you see the entrepreneur getting utility from his consumption of good 2, plus the utility from consuming the dividends coming from the capital stock that the entrepreneur has not sold any equity claims on, so K minus S in the upcoming period, plus the continuation value conditional on survival, going on to the next subperiod 2 in the next period. Here you see the budget constraint of the entrepreneur, which simply says that the cost of consuming good 2 plus the cost of investing X, plus the cost of acquiring liquid funds at price fee B, must be covered by new equity issuances at the price fee S, plus any incoming liquid funds that the entrepreneur has. Here in the bottom, you see the corresponding laws of motion and also the non-negativity constraints on these variables. So most importantly, notice that, of course, naturally, you cannot issue more equity claims or equity claims on more capital stock than you have outstanding and that you are yourself carrying forward. And also notice that the liquid asset holdings of the entrepreneur actually are bounded below as well. So these entrepreneurs are effectively also facing a borrowing constraint in this economy. So that in that sense, these firms can be financially constrained whenever they hit this liquid asset holding constraint in this economy as well. And now, finally, to wrap up on how this model behaves and to illustrate how equity prices can lead to effects on investment in this economy, we find it useful to consider this really simple special case version of the model that is easy to analytically characterize, where all entrepreneurs born in period T die with certainty in period T plus 1. Okay, so here in the second bullet point, we're just simply introducing some notation, but think of this function. This is actually a small script C, not a big script C here on the fraction. So this small script C is simply, think of this as the cost of investing at the investment rate iota per unit of already previously installed capital. So these are the cost of investing at investment rate iota, in contrast to investing at the level X as you saw before. And here, think of again the most basic textbook Q theory convex adjustment cost psi, which are centered around some investment rate iota. And think of this function iota of phi as exactly the investment rate that equalizes the marginal cost of investing to the number phi. Now, this proposition here in the bottom then characterizes the optimal equity issuance and investment decisions of the entrepreneurs in this very simplistic model. For this, we need two more objects. So let us define iota t as the investment rate that exactly equalizes the marginal cost of investing to the equity price of a unit of equity in the financial markets, phi s sub t. And let iota e denote the investment rate that exactly equalizes the marginal cost to the entrepreneur's marginal valuation of a unit of capital, phi s sub e, where phi s sub e is simply the discounted valuation of the dividends from a unit of capital as evaluated by the entrepreneur. So these two investment rates are really the optimal investment rates depending on who is pricing the capital. Is it the outside investors as pricing the capital with the equity price in the market, or is it the entrepreneur pricing the capital? And in that case, the optimal investment rate is iota e. So given this, the solution to the entrepreneur's problem can then be characterized as follows. If the outside investors value a unit of equity more than the entrepreneur does, then the entrepreneur sells off equity claims on his whole capital stock and invests at exactly the investment rate as governed by the equity prices in the market. However, if the outside investors value a unit of capital less than the entrepreneur does, then the entrepreneur's solution depends on the entrepreneur's liquid asset holdings. If the liquid asset holdings, the liquid financial wealth of the entrepreneur is low, more specifically, it's so low that the entrepreneur cannot even self-finance to invest at the outside investor's optimal investment level, then the entrepreneur issues a positive amount of equity and exactly invests at, to exactly invest at the investment rate as governed by equity prices in the market. However, if the liquid asset holdings of the entrepreneur are high enough, the entrepreneur does not issue any equity and his investment decisions are completely independent of equity prices in the market. Okay, so now this second case here could be explained, for example, by agency frictions between the entrepreneur and the outside investors, explaining why outside investors might value equity relatively less than the insider, the entrepreneur himself. Also, actually, in the model, we provide a straightforward micro foundation of this kind of an idea with adverse selection in the entrepreneur's capital quality. Also, this case too will actually be picked up by a calibration targeting realistic equity issuance statistics. And so this case too is the relevant case that we will be actually working with going forward. So again, to recap, in this case too, higher equity prices lead to higher investment, but only for firms who actually have low liquid financial assets and need to rely on equity financing to finance their investment. Okay. Now, so how do we think of these simple model insights when we're looking at the data and thinking about identification in the data? So first, again, to recap, notice that the financial markets block tells us that higher nominal rates, RT plus 1 in this economy, decrease stock prices because they decrease the resale option value of equity in this economy. Moreover, something that you can actually show, and actually I was foreshadowing already before, and Ricardo and Zhengjing have in previous work already tested in the data, is that you can also show that the higher the probability of trading in the OTC market, the stronger the effect of nominal rates on equity prices in this economy. Okay, the most straightforward intuition or way to see this intuition is that, well, if trade in the OTC market didn't take place and alpha, this contact rate was 0, then the resale option value would be 0, and nominal rates would have actually no effect on equity prices in this economy. Secondly, and also importantly, something that we haven't talked about, well, actually we did talk about already briefly, is that all else equal, the higher this contact rate alpha, the higher the observed turnover rate of equity in stock markets, okay? Meaning the more, the higher the amount of stocks traded relative to the amount of stocks outstanding, okay? So that's also something important to keep in mind that we'll come back to. Now, again, to recap what you just saw on the previous slide, the investment block of the model tells us that the resulting decrease in equity prices leads to lower investment rates, but only for firms who actually have low liquid financial assets and have to rely on equity financing to finance themselves. Now, in what is to follow, we will want to start thinking about cross-sectional variation in this parameter alpha, in this contract rate alpha, and the implied cross-sectional variation in stock turnover across firms that we see, okay? So this is why I'm introducing the superscript I on this turnover rate of stocks across firms I on this slide. Now, notice that actually the way I presented the model up until now was the model was presented for a fixed set of equity characteristics, such as alpha, for a homogeneous set of stocks in the economy. So even though we had these heterogeneous entrepreneurs in the model, all the equity issued by all these entrepreneurs was actually identical from the investor's perspective. So there was really one Euler equation in the economy, and all the equity was just trading in the same equity market with the same properties. However, you can actually directly extend this model to introduce stocks with different types of characteristics. And if you allow these stocks to trade in parallel OTC markets, then all the implications of the model that I've shown you up until now go through exactly as before. Most importantly, there will be identical Euler equations for equity prices. However, now there will be a separate Euler equation for each different stock characteristic group. So this tells us that actually we can now start using our model insights to start talking about implications of, for example, monetary policy shocks on stocks with different characteristics. And we will exactly focus on cross-sectional variation in stock characteristic parameters such as the alpha that lead to cross-sectional variation in stock turnover rates across firms, which we actually can see in the data. Okay, all right, and so what we will want to do next is to use exactly these insights from the model about heterogeneous monetary policy effects on stock prices as explained by stock turnover, and try to use those insights to devise an identification strategy to identify the mechanisms of interest that we're really interested in identifying in this model. Okay. Now, and so this brings us to the following set of slides. So now to fix ideas and to tell you how we're thinking about monetary policy transmission through different types of channels, and how we're thinking of identifying the Q channel in the presence of all kinds of channels present in reality, we think of the following structure. So we're thinking about changes in monetary policy rate, so the nominal policy rate, leading to changes in outcome variables of interest. So here, think of the outcome as for example, a firm's investment, working through what we call transmission variables. Okay. So what we mean by these transmission variables is that these are all kinds of variables that might matter in determining the value of the outcome variable of interest. Okay. Or put differently, the outcome variable can be written as a function of all these transmission variables. So literally, these transmission variables are any aggregate or firm-specific variables that could conceivably affect the value of the outcome variable. And what we will, and so the way we'll think of monetary policy transmission is then that monetary policy will lead to changes in these transmission variables, which then will transmit to changes in the outcome variable. And we will think of this chain working through each individual transmission variable, and that transmission variable having an effect on the outcome variable as the corresponding transmission channel being. For example, the most conventional transmission channel these days in monetary policy shock, modeling of monetary policy effects on investment is the real interest rate channel present in new Keynesian models. Okay, so in a new Keynesian model, the nominal interest rate, a nominal rate change, leads to a change in the real interest rate faced by all the firms in the economy. So think of the real interest rate as one of these transmission variables. And so if, for example, real interest rates are high, that stronger discounting of capital returns from capital in the future, and that then leads to lower investment. Now, of course, you can tell me that the higher policy rate, higher real interest rate, because of stronger discounting, will also lead to lower stock prices, which could also be one of these transmission variables themselves. And so you'll see that actually, when there's a change in the real interest rate, then that causes a change in both the outcome variable, for example, again, investment, because of stronger discounting, and also that could lead to a change in another transmission variable, such as Tobin's Q, also because of stronger discounting. But the important thing here to notice is that this positive movement between, say, stock prices and investment is simply arising because of fluctuations in the discount rate, but not because of a causal relationship between stock prices and investment itself. Okay, so another example, for example, of another monetary transmission mechanism working, for example.
Sorry for interrupting. Sorry for interrupting before you go to the. So the discussion we had before about the information channel of monetary policy shocks is important for that argument that you just made, right? To make that distinction.
Yeah, absolutely. So that's what I was kind of I had in mind, that when I said that, when we think about these basic monetary shock channels, we're not thinking about information being revealed.
Right.
I could now tell you. Yeah, sorry. Go ahead.
So now we know. You told us that later you do some robustness checks and everything goes through, so that's fine.
Okay.
But in the sake of the discussion, it's that isolation of that particular channel of interest may be affected by the information channel.
Yes. So I mean, again, if we knew the true model of the world, I would say that in agents' expectations, I mean, I don't know if expectations directly matter, or okay, for example, I could think of one of these transmission variables in light of our model. We could think of the entrepreneur's expectations as one of these transmission variables. Okay. Now, if the central bank reveals information about the future being brighter than these entrepreneurs expected before, right, that would lead to a change in the entrepreneur's expectation. And based on our model, that would actually lead to changes in the investment rates also. So that information channel, in our view, would be a separate transmission channel in this case. Of course, now, again, this revelation of information could a bit get mixed up with other transmission channels. So, for example, if the revelation of information wasn't important, or was not only revealed to the entrepreneurs, but it was also revealed to investors who actually determine stock prices in this economy, you could have part of the stock price kind of fluctuation effects, the information channel, go through stock prices as well, because the brighter expectations about the future lead to higher stock prices. And if stock prices have causal effects on investment, they would work also through the Q channel that we're trying to identify. You're right in that sense. Did that kind of answer your question, what you had in mind? Okay, thanks. So yeah, I just wanted to give you another example of a transmission variable and another very conventional channel that you might see in a New Keynesian model. So for example, in the New Keynesian model, also what happens is that higher policy rates actually lead to lower demand for a firm's products. And so one of these transmission variables could be also just simply the firm's demand, which would naturally again lead to lower investment because of lower demand and lower returns to capital in the future. But also lower demand naturally leads to lower dividends and immediately leads to lower stock prices. So you could again see positive co-movement as a result of these channels between investment and equity prices. But again, these positive co-movement is not coming from a causal relationship between stock prices and investment, but rather being driven by other forces. So just to recap this slide, just so you have some examples of transmission variables in your mind, you could think of here as one of these transmission variables being Tobin's Q, which we're really interested in, or the real interest rate that the firms face in the economy, or, for example, the firm's TFP level, or, for example, the demand for firms' production. So, on the next slide, we're simply introducing just some notation. Again, we're thinking of the policy rate denoted as R here, these transmission variables for an individual firm I let that be denoted as V superscript I here. And then let us think of the outcome variable of interest as this function capital Y of this collection of these transmission variables. Okay. Now, going further, here we're introducing a bit more notation to start talking about changes in monetary policy action. So we will be thinking about changes in the outcome variable of interest as caused by changes in the monetary policy interest rate. So monetary policy actions, changes in R, working then through these different transmission variables. Now, if, for example, the first transmission variable in this list was exactly Tobin's Q, or firm's equity prices, then these blue arrows here exactly capture the idea that monetary policy has an effect on investment because monetary policy moves stock prices for whatever reason, and stock prices have a causal effect on investment. And so these blue arrows exactly depict the Q channel of monetary transmission that we're after. But notice now that based on my earlier discussion, identifying the Q channel can be really difficult because, again, think for example about the real interest rate channel. The real interest rate fluctuations do lead to positive co-movement between investment rates and stock prices themselves, even in a world where there's no causal effect of stock prices on investment, and this arrow here wouldn't exist, and the Q channel would be completely zero. Okay, so clearly that tells us that simply, even if we have the perfect identified monetary shocks, simply studying the co-movements between stock prices and investment cannot allow us to disentangle these channels from each other, and we need to do something more. And this is why we propose as a strategy to start looking out cross-sectional variation between firms in response to monetary policy shocks. So here we're introducing now some more structure. And what we do is we think of each individual transmission variable as a function of the monetary policy interest rate and potentially a vector of firm-specific characteristics, kappa I. Okay, so think of this as a full list of firm-specific characteristics: firm size, firm's leverage, or among others, also the firm's stock turnover rate. Here on these arrows, I've just written, again, the changes in these transmission variables caused by this monetary policy action, just to introduce some more notation. And then these changes in these transmission variables then in turn cause changes, individual changes in the outcome variable of interest through, sorry, let me just zoom in, through the function y. So again, here just this change in the transmission variable of interest multiplied by the first partial derivative of this function y with respect to this transmission variable b. All right? Now, on the next slide, we will introduce even more structure on this. And so what we will do here is we will think of these, we will approximate these functions, these transmission variables, as functions of the nominal interest rate and the firm-specific characteristics, kappa, and we will approximate them based on a second-order Taylor approximation, which you see here. And here we've actually flipped the notation to think about the change in the monetary policy interest rate, the monetary policy action, actually explicitly with the notation that we will be using for monetary policy shocks, epsilon m. And so what you see here is that based on the second-order Taylor approximation, we can split this delta V change as a result of the monetary shock into components that simply depend on the size of the monetary shock, plus components that actually depend on the firm-specific characteristics, and then they govern the effect of the monetary shock on the transmission variables. Okay, and so this is why these kappas appear here interacted with the monetary shock themselves. So again, to give you another example of transmission channels. So for example, you might think that one of these transmission variables is a firm-specific cost of borrowing, and the effect of monetary policy shocks on the cost of borrowing might depend on the firm's financial characteristics, such as leverage, like we already talked. Okay, and so because of that, then leverage would appear as one of these kappas here, and then it would be interacted with a monetary policy shock, and it could potentially lead to heterogeneous changes in the firm's borrowing costs in response to monetary policy shocks across firms. Okay, so that's why these terms are here. And here on the right-hand side, we're simply focusing on the first-order effects of these transmission variables on the outcome variable. And here, these gammas, these coefficients gamma, are really capturing the strength of this effect of the change in the transmission variable on the outcome variable of interest. Right, so let me zoom back out. And so on the next slide. So here we've just brought out the same coefficients that you saw on the previous slide. And now really the key objects of interest become these coefficients. Okay, alphas here that govern how monetary policy shocks affect the transmission variables, and gammas here how these transmission variables further transmit to the outcome variable of interest, for example, investment. Moreover, if I zoom in here, notice that we have brought out one specific alpha coefficient here, which is exactly the coefficient that measures how strong is the effect of a monetary shock on the outcome on the transmission variables, depending on the firm's stock turnover rate calligraphic T. Okay, so again, the stock turnover rate is one of these many kappas that can affect the transmission variables responsiveness to monetary shocks, and we just bring it out to emphasize that it will play a key role in our identification approach. All right. And now, finally, this slide depicts then the key idea behind our identification approach. Okay, so our model tells us, and in previous work, Ricardo, as I've already mentioned, Ricardo has verified that stock turnover is a very strong predictor of the effects of monetary policy shocks on firms' stock prices and Tobin's Q. So this means that if Tobin's Q is the first transmission variable in this list of transmission variables, then this corresponding blue arrow here, that corresponds to how strongly, again, turnover affects the transmission of monetary shocks to the transmission variable. This blue arrow here should be strong, so it should be large and significant. Okay. On top of that, we find it reasonable to believe that a firm's stock turnover does not influence the effects of monetary policy shocks on other transmission variables that might matter for investment. Okay? So essentially what we're saying is that by estimating how monetary policy shocks, or sorry, the responsiveness of Tobin's Q to monetary policy shocks could be explained by stock turnover, turnover in the cross-section, we can effectively identify and estimate this alpha R tau term coefficient here. And if on top of that, we estimate how firms' investment responses are explained, investment responses to monetary policy shocks are explained by stock turnover, we can effectively estimate and identify the product of this alpha and this gamma 1 here. And then effectively, we can identify the gamma 1 term here, which is exactly capturing the causal effect of stock prices on firms' investment. Okay. Now, immediately also, this allows us to explain how this identification channel handles other competing monetary transmission channels. So for example, again, thinking about the real interest rate channel, notice that when there's a monetary policy shock, then the change in the real interest rate faced by all firms in the economy is the same for all firms. So it cannot be correlated with a firm-specific stock turnover. So immediately this tells us that our estimates will be completely clean of the classical real interest rate channel, because again, it will be the same for all firms. Now, of course, more recently, there's now a lot of work, as we've already talked about it today, that there might be more elaborate channels and more elaborate models. For example, as I've already said, that these transmission variables might be actually firm-specific costs of borrowing, like, for example, in the model of Ottonello and Winberry, right? And then what could happen is that, for example, firm leverage could itself predict the firm's borrowing cost responsiveness to monetary shocks, and actually that might ruin our identification if leverage happens to be correlated with stock turnover. And this brings us then to the following slide. So what we work out, and we're still working out really cleanly in the paper, but ultimately what we show is that what you at a very high level want to do to identify, again, this gamma 1, so here I'm just denoting it as gamma as the coefficient on Q of interest here, is what you want to do is you would want to estimate firm level regressions. So here, Y is a generic outcome variable of interest, for example, the investment rate. So you would want to estimate firm level regressions where you instrument for the cross-sectional variation in firm's Tobin's Q with the monetary policy shock interacted with the firm stock turnover just before the shock. Why am I emphasizing cross-sectional variation across firms? Notice that there's also a time dummy here. So we're, again, soaking up any joint variation in these outcome variables that are shared across firms, and we're really focusing on between firm variation here. Also, what you should do is you should add controls of monetary policy shocks interacted with other firm level observables to control for other types of channels. And so again, we're still working this out in the paper, but essentially the identification assumption for causality in this case is that, or effectively the instrument exogeneity assumption, is that the effect of monetary policy or the strength of monetary policy transmission on the outcome variable of interest through channels other than stock prices should not be dependent on the firm stock turnover or on other firm level characteristics that are correlated with stock turnover and have not been controlled for here among these controls. Okay, so again, to give you the same example I've been giving you throughout, suppose you're worried that firm's leverage is correlated with firm stock turnover. And let's say by the work of Ottonello and Winberry, you would think that then leverage heterogeneity predicts firms' investment responsiveness to monetary policy shocks. Well, then what you want to do is you should just stick in leverage as one of these kappas here as controls, and you're good to go to clean out that effect. Okay, and so in the regressions, in what is to come, actually in the baseline regressions, this set of kappas we will consider to be the empty set, but in robustness tests, we control for leverage, firm's liquid asset holdings, firm size, age, and other types of conventional measures that you might be worried about leading to heterogeneous firms' responsiveness. All right, so let us finally hurry to the empirical part. So yeah.
Sorry, may we go back a little bit?
Sure.
So there is, I'm not exactly sure how this may be related, but since this is about measurement, there is all this literature that, for instance, this paper by Gornichenko-Weber and another paper. So in Gornichenko-Weber, what they do is that they show that firms with the stickiest prices have stronger effect of monetary policy shocks on stock returns. Or there is this other paper also by Weber and some co-author that argues that the distance from final demand in the production chain affect the way in which monetary policy affect that particular firm, and that will be reflected in stock prices.
Yes.
Are those pieces of evidence a concern to the strategy that you're showing us today?
So that's a very good question, and that again talks exactly. No, that's a very good question that exactly talks about potential concerns with this identification approach. So let me focus on the example of the price stickiness. So you're absolutely right that would be a concern for us if firms' price stickiness was correlated with their stock turnover. Okay, if price stickiness is not correlated with stock turnover, then it would not be a cause for concern because essentially an omitted variable that would not be correlated with our instrument actually. Okay. However, if you are concerned that firm's price stickiness is correlated with stock turnover, and we do not add price stickiness as a control here, then it might mess up potentially our identification approach. However,
this is not turnover. This is turnover interacted with monetary policy shock. So is turnover due to monetary policy shocks? It's not an unconditional thing, no?
No. So this is before the monetary shock. So we're thinking about turnover here, not conditional on the monetary shock, but measured just before the monetary shock. So we're thinking of these as firm-specific characteristics that, for whatever reason, are heterogeneous across firms. And then when you hit them with a monetary shock, the firms with high turnover respond relatively more, the firms with low turnover respond relatively less. So another thing that I wanted to point out is that the way you're putting it, again, this is going too much into it, but if price stickiness was only a source of stock price fluctuations and not a source of other types of fluctuations, real fluctuations in the economy, or heterogeneous responsiveness of real decisions of these firms, then actually price stickiness itself would be a good instrument. However, it's clearly not the case because the whole point of Gornichenko and Weber is that because price stickiness affects firms' real outcomes, because of that, the firm's stock price responses reflect price stickiness. So in that sense, again, if you believe that price stickiness is not correlated with stock turnover, you shouldn't be worried about it. But if you do believe that it's correlated with stock turnover, you should control for it in this regression as well to clean out that effect, because otherwise our instrument wouldn't be capturing what we want. But thanks, those are very good questions. Exactly hitting the point of the identification approach.
And the same thing will be true for the distance to the final demand. It's also characterized. It's the same argument. Okay.
Absolutely. That's why I didn't talk about it, because I forgot. But exactly, that was the exact same idea. Okay, so let me
something about the. It could be things that are correlated with turnover, but through other channels. For example, leverage. Okay, I understand that leverage can affect the interest rate of the firm, but clearly the leverage maybe is harder to have for a firm that have a lower turnover, because in some sense the collateral they can put or whatever they can put is lower. So in this case, it's not just to control for the leverage, but it's to control for the leverage interacted by turnover. So at the end of the day, is in this case, how you will be able to identify that. And clearly, turnover make that the asset is more liquid, so it's a better collateral. And that will reduce your amount of the cost of capital. So how is this type of things that can affect the estimation? And in this case, you will need to have a control that is the interaction of the leverage times the turnover.
I mean, I don't exactly see why you would want to add as the control the interaction between the two. I'm sorry, I just don't see it. But I do see.
The point is that, in some sense, that your ability to have a higher level of leverage is how liquid is your asset. In some sense, that's made that if you have a liquid asset, it's a better collateral.
Yeah.
So again, it's different to have a level of collateral 10% for an illiquid asset that to have a firm with illiquid asset that to a level of collateral of 50 when you have a liquid asset, because okay, the bank or whatever, the bank is more willing to lend you because you are more liquid, you have more turnover. So you have this interaction between your cost to access and to discount the future and your level of collateral and turnover, because turnover is a proxy of how good are your collaterals.
But I mean, my response to that, I absolutely understand your logic, and this is actually a force that could play a role in our model as well. But again, my response to that would be that you're absolutely right. This is a way through which, let's say, cross-sectional heterogeneity across firms in their turnover will allow them to get differential leverage then, okay? And then that might be a concern, because this differential leverage might itself be a source of heterogeneous responses to monetary policy.
Yeah.
But again, my point here is that once you add, sorry, let me just finish that. Once you control for leverage in this regression, you're essentially netting out that correlation between leverage and turnover, right? And what you're still left with, and what the variation that you're left with as the instrument is all the turnover in the firm stock prices that is not explained by leverage, and thus is cleaned of these effects of monetary transmission that could be explained by leverage, and you're left with only the turnover part that is not correlated with leverage. That would be my view on it, and that would be essentially the pure liquidity effect, or the stock price effect that we're after. Okay, so again, I could clearly see how higher turnover could lead to higher leverage could lead to more responsiveness. We want to get that effect out of our estimations. So what we want to do is we will want to control for leverage times the monetary shock to clean that out, and that's what we do.
The only point is whether the effect of leverage in your cost of capital for you is not correlated also with the leverage, your initial level of leverage, in terms that maybe the leverage affects financial your cost to finance, because you have more problems to get credit. Okay, but this amount, it could be different, whatever the reason. Whatever the reason, a level of 10% of leverage can have an effect in your cost to finance from a bank, different whether you have a liquid asset or a not liquid asset. So only to control for the level of leverage is not enough.
Okay,
That's
now I see. Okay, now I see your point. Okay, those non-linearities we haven't really thought about.
That whether, because in some sense liquidity is related with the quality of your asset as a collateral, so it has
I
been.
understand. Yeah, I understand now your concerns. Yeah, no, that's a good point. I'll have to think a bit more about how, if we would be concerned about those kinds of extra triple interactions, how those might appear in our estimates. But that's a good point. That I need to think a bit more about it, or we can talk a bit more later at the end of the talk. Okay, but thanks, you're right. Okay, so let me just quickly, I don't have much time left, so let me just quickly jump to what we do in the data work. Okay, so as for the data, we use for monetary policy shock identification, we use the standard high frequency identification approach to monetary policy shocks based on federal funds futures rate changes in narrow windows around FOMC announcements. And as I already mentioned before, we also control for whether our findings are robust to using instead monetary policy shocks that have been cleaned from information effects, as for example proposed by Yarochinsky and Karari. As for firm level data, we use data from CRISP for firm stock turnovers, and we use firm level data from CompuStat for balance sheet data. Okay, and all our analysis will be at quarterly frequencies. Just to give you an idea of the variables we're using, so Tobin's Q will be the market to book ratio of the total balance sheet of the firm, and the investment rate that we're using is the capital expenditures ratio relative to the property, plant, and equipment of these firms. Okay, and so let's get to the first regression. So as I said, ultimately we will want to do an IV regression, which we do later on. However, as a smell test, what we do first is simple OLS regressions to check whether these qualitative findings that we're expecting to see based on our model actually are there in the data. So effectively what we're doing is we're testing the first stage of the IV regression, and we're immediately estimating the second stage, directly regressing on the instrument, if you will. So more specifically, what we're doing here is we're applying a standard local projections approach in the panel setting, where Y denotes a firm level or firm I variable outcome variable of interest. So think of this as the firm's log Tobin's Q. The equity issuance is to total balance sheet size, where B now denotes total balance sheet size, or the log investment rate of the firms. So these logs actually give better fit of the data, but we also verify that if you drop these logs, all the main findings still go through. And so the key idea of this local projection here is to estimate whether identified monetary policy shocks, epsilon m, lead to heterogeneous responsiveness in the outcome variable of interest, as explained by the firm's pre-shock stock turnover, as measured, again, just before the shock. And the key parameter of interest here is this parameter gamma h, which exactly measures this heterogeneity of responsiveness at horizon h after the monetary shock. Also notice that this panel local projection includes firm fixed effects and time times industry fixed effects. So all the variation that we will be using will be between firm within industry variation. Now also note that our model has very clear predictions that high stock turnover firms' stock prices should be more responsive to monetary policy shocks among all firms, but stock price variations, these stock price variations should in turn predict stronger investment and equity issuance responsiveness only among firms with relatively low liquid asset holdings. And because of this, we repeat this estimation also, allowing for all coefficients to be different depending on whether the firm had high liquid asset holdings or low liquid asset holdings on their balance sheet just before the monetary shock. Okay, and now let me immediately jump to these OLS estimates. So here we're depicting all these estimates of these gamma h's running from left to right over horizon 0 up to 12 quarters after the monetary policy shock. And here you have the outcome variables of interest in columns. So you have on the left-hand side, you have the log Q, equity issuances in the middle, and investment rates on the right. In the top row, we're pooling all firm quarters, and in the bottom row, we're splitting them up based on firm liquid asset holdings just before the monetary shock. So looking at the first top left-hand, so these dashed lines here are the 95% confidence intervals of these gamma h's. So looking at the top left corner here, what you see is that the turnover channel is operative for all firms. Okay, so among all firm quarters, what these negative estimates of gammas here show that in response to a positive epsilon, which is an unexpected policy rate increase, firms with higher stock turnover exhibit relatively lower stock prices. Okay, so that the drops in stock prices of firms with high stock turnover, are actually larger, exactly as found in earlier work by Ricardo, for example. Now, if you look at the bottom left-hand side, what you'll find also very nicely, as predicted by the model, is that this heterogeneity in stock price responses, as explained by stock turnover, is equally strong for firms with high liquid assets on their balance sheet or low liquid assets on the balance sheet. So the first stage from stock prices to investment, as explained by stock turnover, is working very well for all firms, as exactly the model would say. Now, if you go to the middle column and looking at equity issuances, what you see here is that among all firm quarters, higher stock turnover does lead to or does predict stronger equity issuance drops in response to contraction in monetary policy shocks, somewhat. But if you split the firms up based on their liquid asset holdings on the bottom panel, what you'll see is that it's the red guys, the guys with low liquid asset holdings, whose issuances respond relatively more in the short term, at least. In the longer run, also the high liquidity guys' responses have a bit of significance, but actually that is not significant in all our specifications. And finally, if we go to the right-hand side, again, among all firm quarters, firms with higher stock turnover seem to exhibit stronger investment drops in response to monetary policy contractions. But again, if you split firms up based on their liquid asset holdings just before the monetary shock, you really see that it's the low liquidity guys whose investment is responding, among whom higher stock turnover predicts stronger investment contractions than among the firms with high liquid asset holdings. All right, so let me just quickly run on. So ultimately, so now we see that the
sorry, Priit,
yep,
you have 5 minutes.
Perfect. Okay, so there's a lot still to cover, but let me just show you this main part. So, so the model, the empirical findings pass the smell test. That the first stage of the IV regression seems to be very strong and seems to be there, and also there is indication that the second stage should work out relatively well. So what we ultimately do is now estimate an IV regression Q regression as written in the form of a local projection, now regressing outcome variables of interest at horizon H on the Tobin's Q of the firm H quarters than before. And now this Q will then be instrumented with firm stock turnover interacted with the monetary shock, as exactly I explained to you before. And now the outcome variables of interest will be the equity issuances and investment rate. Okay, and so this is how we control for other channels in robustness, but let me just skip that for now. And here are the IV estimates. In the left-hand side column, we have the equity issuances. On the right-hand side, investment rates. Again, pooling firms in the top, splitting firms up based on liquid asset holdings on the bottom. And so what you see is exactly what you would expect based on the first stage OLS and what you saw before based on two-state least squares intuition. Higher instrumented Q will lead to higher equity issuances among all firm quarters. But again, if you really split them up based on the liquid asset holdings at horizon 0 or just before horizon 0, it's really the firms with low liquid asset holdings whose equity issuances respond to instrumented changes in Tobin's Q. The same ideas go through for investment, that again, among all firms, higher Tobin's Q, instrumented Q, will lead to higher investment. But again, if you split the firms up based on liquid asset holdings just before horizon 0, you see that firms with low liquid asset holdings are the one whose investment is actually responding to instrumented Q. To give you a sense of magnitudes, this estimate here of approximately 1 tells you that a 1% increase in Q leads to a roughly 1% increase in the investment rate on average for these low liquid asset holding firms about 3 quarters afterwards. Now, I'm really out of time. Also, something we do is we also run the exact same regressions for other firm level balance sheet characteristics or balance sheet variables that to study what these firms might be doing with their balance sheet. And what we see is that these firms whose equity issuances are responding, they are becoming relatively larger, but they're not adjusting their levels of liabilities. So effectively, they are becoming more equity financed. So they issue more equity, they become larger, but they don't adjust their levels of liabilities. So let me just skip on the asset side, and let me finish up on what we do with a quantitative model. So we go fully computational quantitative with a model that you saw before. we'll have a model with heterogeneous firms where there will be a full distribution of firms' liquid asset holdings in the model. And one key extension that we also introduced in this model is a stochastic fixed equity issuance cost that all firms have to draw at any given point in time whenever they want to issue equity. This is not important qualitatively for our model to give these predictions, but it's important quantitatively to actually match the model to realistic statistics on equity issuance frequencies. And so what the model looks like is firms will start off their life, meaning they will have an IPO. They will start depleting their liquid asset holdings because they want to smooth investment. When liquid asset holdings run down, they will want to go to the equity market and issue new equity. And actually, the equity prices at the time when they are issuing, those equity prices exactly govern how much equity they issue and how much they invest at the time of the issuance. Most importantly, because of these fixed equity issuance costs, firms actually go to the equity market only very infrequently. And that's why high liquid asset holding firms are less likely to go to the equity market and less likely to expose themselves to fluctuations in equity prices. We calibrate the model. I won't have time to talk about this. And then this is the key result from the model. Here we overlay on top of each other these reduced form estimates that you just saw from the ID regression a few slides ago, what firms on average do in response to an instrumented change, a 1% increase in Tobin's Q. And here in green, we conduct the same experiment in the model. We shock the model with a monetary policy shock so that firms in stock prices go up by 1%, and we trace out the average responses of firms' investment in response to that shock. And here we exactly see that also in the model, it's the low liquid asset holding firms whose investment rate responds relatively more, and the numbers line up surprisingly well as well. Note that we haven't done anything in the model calibration to make sure that the reduced form estimates line up with the structural model impulse response. We just calibrated the model in steady state, and this is what we got. And then, sorry, I'm over time. Last slide. What we then ultimately want to do is now having confidence in these estimates of causal effects of stock prices on investment. What we do is we chain together these estimates of how stock price fluctuations lead to changes in investment rates, and we chain those together with well-identified, well-known average effects of monetary policy shocks on stock prices. And what we can tell you then is that on average for the public firms in the US, in response to a 25 basis point monetary policy shock, the average public firm's investment rate drops by about 0.6% because their stock price is dropping. And this is exactly going through this stock price channel, this Q channel. And doing a slightly more elaborate aggregation, taking into account the importance of public firms in aggregate investment in the US, we actually find that in response to a 25 basis point unexpected increase in monetary policy rates, about 0.14% of the aggregate investment drop could be explained by the channel transmitting through stock prices. Now, there are, of course, some caveats about this number, but to give you a sense of magnitude, the aggregate total effect of Cristiano, Eichenbaum, and Evans is about 0.45. So the aggregate effect of monetary shocks on aggregate investment, and our channel then could explain about 1/3 of that aggregate response to monetary policy shocks, exactly working through public firm stock prices. Okay, so now I'll conclude. So what I've shown you today is I've presented a theory of how monetary policy can lead to changes in firm stock prices and how this can lead to changes in firms' investment. This model has also proposed a strategy to identify the key channels of interest, and we've shown you reduced form estimates that show that this channel of transmission through stock prices seems to be economically and statistically significant, and our reduced form estimates seem to line up with our calibrated structural model estimates of the same channel quite well. And back of the envelope calculations suggest that the transmission of monetary policy shocks through public firms' equity prices could potentially explain a considerable fraction of aggregate monetary policy transmission of monetary shocks to aggregate investment in the US. And yeah, so that's it. Thank you very much.